Well, fortunately, we're not getting a lot of phone calls. We've kind of been warning clients that this is what the world's going to look like. It's going to be very volatile. My short answer to your question is I don't think it's time to get out. I think that you're in the market. You're looking at it on a 3 to 5 year time frame. This horrible situation is going to pass in the next 2-3 months. And you got to be very, very careful that you don't react too emotionally to these type of news events and these type of market swings, because it can go the other way just as fast.
Meb, we've sold off quite a lot. Talk to us about where that puts valuations of the broader index.
First of all, that was very well said. Don't be emotional. But everyone knew coming into 2020 the U.S. stock market was expensive. It wasn't crazy like 1999, but a long-term P/E ratio of around 32. Well, that's declined pretty quickly. We're sitting at around 25 right now, so still expensive, but not terrible. During low inflationary times, it's around 21, 22, which is still 15% from here. And the long-term average, going back to the 1800s, is down around 17, which is about 30% from here. So you could have further downside, but the question is, how much worse can it get? As we know, valuations don't always stop at the average. On the upside, they went way higher, and they could easily go back to the global financial crisis low, or the low teens, which would be 50%. So you got to prepare for all those scenarios, just like you got to prepare that the market could romp back to all-time highs. The most likely scenario is further downside, but after a lot of the carnage, the good news is foreign equities look a lot better. Foreign developed is much cheaper. Foreign emerging, you're already at the low teens P ratios, and the cheapest of the cheap, you got a bunch of countries right now that are trading in mid-single-digit P ratios. At some point, that's going to be a generational buying opportunity.
Should mention those numbers Meb used for P were cyclically adjusted P ratios, if they're a little different from what you typically hear us talk about. Michael, my question to you, you came on with us a couple of weeks ago, March the 3rd, I think it was. You said you were buying MasterCard and Disney on the dips. How do you think about those purchases now? Do you regret having made them, given that we've fallen further from there?
Well, I think, first of all, we weren't necessarily buying them on that day. These were positions that we own. But, I think these are good brand names that are going to do well long term. If you look at what's happening with Disney, Disney's at 90 or somewhere near that. What's it going to do when the parks close? Because I think the parks are going to close in the United States. Maybe it's going to go to 80. Here's the question. If you had $100 and you put $90 of that $100 inside of Disney stock, what's it going to look like in 5 years? That's what you really have to look at. So I know it's very, very easy to sort of second guess holding anything for the last 2 weeks, let alone anything travel related. But again, you have to try to look past this as best you can and ask yourself, what would you be doing if you had cash? And if the answer is you'd be buying some of the names that are cheap right now or have gone down 30, 40, 50%, you got to look at that. You can't just look about what the downside has been lately.
Meb, when you're talking about how do you position if you've got another 50% downside here, what does that mean exactly?
When we talk about an investment and how to hedge it, if you're looking at, say, U.S. stocks, so let's say you came into the year, you knew they're expensive, the best way to hedge a risk is not to take it in the first place, so own less. The second one would be to own other asset classes, foreign stocks, which don't really hedge, real estate sometimes, commodities, gold sometimes, bonds usually hedge. The next step would be to, say, tilt towards value. That hasn't helped at all this year. Trend following being another one.
Can I just ask you on the bond front, you say they usually hedge. Are they not right now? And is that?
Oh, they've been awesome. They've been awesome this year. But if you look at the worst months in the S&P in history, they're not guaranteed. But once you do all those things, that's a pretty good portfolio already. Trend following's helped a lot this year. Managed futures, and then you can get into tail risk. And that's something that is almost universally guaranteed to do well in the bad times. The way we express it is we pair government bonds, so 10-year bonds, with puts on the stock market. Because a lot of the other assets, as we've seen this year, gold today is a great example. It usually hedges, but not always. And something like a tail risk after the 10-year run we've had, monster bull market, first decade ever without a recession, high sentiment, yada, yada. Seems like a prudent thing to do, and to the extent we don't know if there is more downside, could be something that could really help a lot of people survive and at least see something green when the times are bad.